we've seen this recipe to pour new debt over the old debt. Did this work? Are there any inflationary expectations in the near future?
Well, it doesn't work because the crisis started with too much private debt, and then we socialized the losses, and now we have too much public debt. Then some of these sovereigns have lost market access, and they are now being bailed out by supranationals. Greece, Ireland, Portugal being bailed out by IMF, ECB, EFSF, EU, you name it. But you cannot kick the can down the road of this stock of public debt from private to public to supranational. Nobody's going to come from the moon or Mars to bail out the IMF or the ECB if the debt is too much and you cannot grow yourself out of a debt problem, if you cannot save yourself out of the debt problem, and if you cannot inflate yourself out of the debt problem because the ECB is not going to allow inflation to erode the real value of debt, then there is only one other solution: debt restructuring, debt reduction, done in an orderly and market-friendly oriented way.
And what about the inflation in the Eurozone and in the US?
Well, inflation has been temporarily going higher because there's been the rise in food and energy and oil prices. In my view, inflation is not going to be a big problem in the United States or the Eurozone and in most advanced economies because you have a big slack still in goods market. Demand is soft. Firms don't have a lot of pricing power. They cannot transfer the increase in their input costs to consumers. Secondly, there is a huge slack in the labor market. Unemployment is around 10% in the US and Europe. Workers don't have wage bargaining power. Wages are growing less than productivity. Unit labor costs are falling, and since 70% of cost of production are labor costs, it's hard to see how you're going to get inflation through wage inflation. And three, in many economies, you still also have a huge recession in real estate and housing when there was a boom and a bust. So slack in goods markets, labor markets, and real estate market implies that while there will be effects on the headline inflation, first round, there is not going to be significant increases in core inflation, excluding food and energy, through wage and price inflation and through second round effects. So I don't see a significant problem in most advanced economies. In emerging markets, it's a different story.
I'd ask you about this, of course, about the emerging markets problems with the inflation. But first of all, I'd like to ask you about the printing press in the US. When do you think that the printing press will stop in the US? And if you see any credible exit strategies for quantitative easing programs and so on?
Well, the Fed has already announced that QE2, quantitative easing second round, is going to be over in June. And for now, we're not going to have a QE3 because the economy is doing well, because inflation, however, gradually is rising. And even the Fed is now trying to signal the pace at which they're going to try to mop up the liquidity and then raising interest rates. In my view, the Fed is going to do it very slowly and gradually because the economy is weak, the labor market is weak, housing is weak, and inflation is still low. So the exit of the Fed is going to be relatively slow and gradual. I don't expect them to increase the federal funds rates until maybe the second half or the latter part of next year.
Do you still have risks for a double-dip recession?
Not a double-dip recession, maybe today, but there is signals that global economic growth is slowing down. The latest data from the US, first quarter, second quarter, slowdown. In the Eurozone, the periphery is contracting, and even the strong growth of Germany is slowing down. Japan entered a recession now because of the earthquake. Even the data from China suggests a slowdown of global economic growth. And the markets are now becoming nervous. Until now was a moment of risk on for a few months. Now risk is off. And as we know, there are many tail risks to global economic recovery. Rising food and oil prices, turmoil in the Middle East, the Japanese earthquake, the problems of the periphery of the Eurozone, Portugal, Ireland, Greece again, the risk that the US fiscal deficit eventually, not soon, might crowd out the recovery by having rising interest rates. So there are many tail risks that can hit the global economy, so it's still a fragile global economic recovery. I don't expect a global recession, but if oil prices were to rise another 20%, of course some of the weaker economies like the periphery of the Eurozone, UK, Japan can have a double-dip recession.
From your point of view, what's the best portfolio now, to own cash, to own stocks, to own treasuries?
Well, I would say it's diversified. I would stay neutral, not overweight on equities because they've gone up so much that now there are risks that growth surprise on the downside, profits and earnings and margins are going to surprise on the downside. On government bonds, you have to be careful. I would stay away from the periphery of the Eurozone and countries that have too much public debt and deficit. I think the US Treasuries at these levels are fairly valued. They're going to stay at these levels. I think that the government debt of economies that have sound fiscal policy, including those in emerging market economies, is a good bet. Until recently, it was a good story to be overweight in commodities, but now with slowdown in global growth, maybe commodity prices may soften a little bit as they have. So I would say diversified portfolio in which increasingly, as we're moving away from a risk-on mode to a risk-off mode, is better to stay away from things that are slightly more risky, whether it is kind of risky credit and debt or some kind of risky equities in countries that are going to be experiencing an economic slowdown.
And my last question, Professor Roubini, is about an emerging economy like Romania. What are your thoughts about the Romania's economy, about the inflation, about the highest interest rate and inflation in the European Union?
Well, Romania is now, good news, recovering after 2 years of recession. The latest data suggests that, export growth is driving at least positive economic growth. It's still very weak economic growth. Inflation has been rising because of half of the consumer price index being food and energy, and because of the delayed effect of increase in the value-added tax. I think that inflation is going to go up a little bit, but then it's going to start to fall as the effects of the VAT and the commodity prices tend to wane. One way of reducing inflation to let the currency strengthen, and there's been some strengthening, but if you do it too much, you risk losing competitiveness. And, inflation is above the policy rates, but if inflation is going to gradually fall in the next few months to a lower level, probably the current stance of monetary policy is appropriate. Of course, there is now a precautionary program with the IMF. More fiscal adjustment is needed, more restructuring of state-owned enterprises, and trying to be investing for the future. But Romania has been reasonably successful to weather the storm, do the adjustments, more is needed, and I would be mildly positive about the economic recovery of Romania in the next few quarters.
Professor Roubini, thank you very much for joining us here at the Money Channel. It was an honor to have you as a guest. Thank you again.
Pleasure being with you today.
Thank you.